Good morning, ladies and gentlemen. For those online, we do apologize. We will be starting shortly.
We're just waiting for everyone to come in from outside. Yeah, leave a mic with Erica for the questions, for the Q&A. Yeah, can Erica be mic'd up at the back, please? I know. To the guys online, apologies. It's not that we intended to start late. We just have a good catch-up and coffees and breakfast with those in person. So apologies for starting a few minutes late. Okay, I'll let the others come in from outside. I can see still a few faces outside, but let's kick off because we do have a couple of speakers. Thank you, Neil. We do have a couple of speakers, and we're trying to get through the agenda in just on an hour. I think I got it, guys. Just on an hour, and then we will take some Q&A. So this is our second session for the year. And thank you very much to all of you guys coming in person. I hope we get more foot traffic in person because it also gives us the chance to connect after the meeting, especially with our counterparts where there's common themes and initiatives. We also in our cycle at the moment of a number of trade advisories across the different asset classes. So while it's not the entire breadth of the market, through a forum like this and through our industry sessions, we're hoping that we can get to a number of clients to discuss really pertinent topics. This session is really to talk about our roadmap. So we don't focus more on the strategic direction, but just on the book of work that the JSE is focusing on for the 2020, the current year, 2025, trying to look out in 2026, and then to have discussions about key trends or initiatives that we might do as a collective. And because it's multi-asset class and various streams, it touches a number of you guys. So usual, we're going to start off with the technology stream, which Robin's going to cover for Tabalo. One of the areas we will be highlighting in the tech roadmap is our own initiatives And you guys know that's a long book of work for us, which we systematically sequence just in priority, but also to cover a few highlights of what we had announced earlier this year on the Amazon NASDAQ collaboration. While we are still working through the detail between our internal teams, there's an infrastructure journey that we hope to embark on, which will be modernizing as well as lifting up JSE, but SA Capital Markets. Helena Andy will cover the capital market section, Alicia clearing and settlement, Barbara will cover information and data, and then Sapiso's covering policy and regulation. We can do Q&A after each session, and each speaker will just pass on to the next, so I won't come back up, but we will facilitate Q&A after each section and then again at the end. Over to you, Robin. Thank you.
Thanks, Al. Good morning, everybody. Okay, so welcome and thank you for your time. As mentioned, I'm going to be covering some of the technology roadmap items. It's by no means the full list of book of work, but it certainly is the strategic items. Some of them we spoke about in February through the first sessions that we had with the market. So hopefully to give you a bit of an update where we are, and I'm happy to take some questions as we go along. So as Val mentioned, we've engaged with an MOU with a collaboration with NASDAQ and AWS. And at this point, it's very much exploratory. So the strategic intent really is to see how we can collaborate and engage through interconnectivity and specifically around the technologies that both these giants offer from an AWS and NASDAQ perspective, focusing on things like global infrastructure, and there's some other solutions and services that they offer in that space, specifically with NASDAQ, that we're quite interested to hear about and learn and see what they could obviously provide us input into as we deliberate and think about things for the future. So what are the steps that we've identified from an infrastructure perspective? Sorry, is really to explore the NASDAQ infrastructure technology stack. They obviously offer a broad range of market infrastructure capabilities, and we've had some interesting and fruitful engagements with them around some of those offerings. We're also looking to leverage their Fabric platform. That's the interconnectivity that AWS offer globally, and looking to see what we can do down in South Africa and what that would bring in terms of capabilities, not only for us, but also for our clients. So lots of design around some of the workloads that AWS offer, some of them in the AI space. We're very interested in the Bedrock and some of the capabilities that they offer, and we're having some collaborative sessions with AWS there. And then also what it could potentially bring to enhance our offering services in the colocation space. The pack will be shared at the end of the session, and there is a link at the bottom there with the announcement which was made in April. You're welcome. There's a lot more information in there, but you're also welcome to come chat to me after the session. Okay, so as we move on into the roadmap itself, just touching on 2025, as you know, we've gone live with the Zeronia, the listed bonds instrument, from a system replacement enhancements perspective. We're currently busy with the design around the Pentagon upgrade. This is the next version from an MRT platform for the surveillance system. That's a work in progress. It's a multi-year program, and we're looking to progress that into 2026 and with a go live sometime around 2027. There's the SENS replacement 2.0. This is a full platform replacement of our SENS announcement system. We've gone through an extensive process with a set of potential vendors. We've chosen the vendor and we've kicked off that project, and we are excited that that is now moving forward with a view to land that in 2026. In terms of some of the system upgrades and modernization, as you know, we've embarked on a rather extensive and very detailed modernization and a program, specifically focusing on our legacy of technologies in the mainframe space, but also in the trading and clearing space. So we from a BDA modernization perspective, as mentioned in February, we had embarked on what we call the pilot, which was a set of lines of code from the BDA application itself, where we are converting from COBOL legacy mainframe technologies into Java hosted in the cloud. And I'm pleased to say that the first iteration and the code drops that we've received from the partners, being AWS and Blue Age, have yielded very interesting and fruitful results. And we're looking forward to the next set of code, which was envisaged to be in the next couple of weeks. That would then conclude the pilot phase of the modernization, and then we would look to move into mass modernization. One of the questions that came up in February was, when are we going to start engaging with the markets, preempting the question. We want to see what the outcomes of that particular piece of work yields, but we're very positive and hopeful that we will start the formal engagements with the broker, the community that make use of BDA around September, towards end of September. In terms of also from an upgrades modernization, we've embarked on the bond CCP development. That's kicked off now, and that will also move through into 2026. Also to mention, what we will be focusing on in 2026 is the detailed design and analysis of the replacement of some of our legacy systems that host the commodities, interest rate derivatives, and bonds platforms. As you know, that sits on aging technology, and we'll be going into a detailed design and analysis. We've engaged with a number of providers. We've selected and shortlisted who we think those providers could potentially be for the future, and we're having a number of design sessions with them already this year to understand exactly what it is from the gap of out the box versus what our markets require from a functionality perspective. And again, this is a multi-year journey, so the focus in 2026 would really be around the detailed design, engaging with the market, understanding the impact, with a view to then progress that beyond 2026. It's a very big piece of work. We're very much aware of the impact that this will have on the market. And again, we'll be working and collaborating very closely with you on what that means to every member that makes use of that technology. Then perhaps just to mention around some of the upcoming events for this year in particular, where there are impacts to the member community. As you know, we conduct a number of disaster recovery tests. We've successfully concluded on our first one, which was at the 7th of June. That was an internal technical test. We're going to have another one on the 16th of August. Again, internal, no requirement for participation from the members. But there is one in October. It's penciled for the 18th. We have communicated that date, and that's where we will require full market participation for the testing of our disaster recovery. And as always, from an operational infrastructure perspective, we've got a set of routine scheduled maintenance weekends, whether it's infrastructure upgrades, security patches, network upgrades, etc. And that goes without saying that that's part of the operational, to ensure the resilience within our environment. So a lot on the go. It is very high level, I know, but those are the big ticket items. We're very excited about the BDA modernization one in particular. We've seen what the first pieces of code have yielded. We've seen it in live action working, and I must say it's looking good. So I'm going to pause there. I know that there are questions towards the end as well, once everybody's had their respective presentations, but if there's any questions, I'm happy to take them now. Particularly any questions online? None. Great. Well, then thank you for your time, and I'd like to hand over to my colleague, Helena.
Morning, everybody. Feels like I've just addressed the team and it was 6 months ago already. So the year is really flying by. On the capital market side, there's been a lot going on. I guess what we've been trying to achieve is, bring new products to market that will be fit for purpose. Look at enhancing our valuation methodology just to make it more standard, and also bringing out, ways of standardizing the way that we currently, whether it's a fixing or whether it's a way of, marking to market. So those who have been the three broad topics that we've been trying to address via the different projects that we've engaged on across the different asset classes. So starting with primary market, I think, we are still, obviously, the new listing is a big focus for us. The only thing I would like to mention there is, obviously, Robin has mentioned the NASDAQ MOU. I think from this specific angle is just to unlock more unlisting via the NASDAQ MOU. That is the one thing that I would like to highlight. On the market simplification phase, that is still sitting with FISC, unfortunately. So hopefully the guys, I've touched base with the team and they said it's looking promising. So hopefully we'll get that, something out in the next couple of weeks. In terms of segmentation project, if you could recall, we've moved now to 2 different segments. We've simplified into main and general. And after, I think it's been after 1 year or so, 23 companies or issuers, especially around the mid and small cap, have moved to the general segment, which has been very, very positive. And then the other projects are still ongoing, and there's nothing much to highlight there. In terms of cross-asset class, just talking mostly about our connectivity and infrastructure piece, which is anything to do with connection and accessing the JSE. As you would recall, we went live with JSE Fix Hub a couple of months ago. So just as a reminder, JSE Fix Hub is our order routing network, which connects buy and sell side clients for their fixed messages. So since we've gone live, there's been a big interest. We have 2 signed order forms, and we are busy onboarding a lot of clients. That was, of course, to address the need of the market. They wanted another solution that will lower the cost of a fixed order routing, which would be venue and technology agnostic. So this has been very, very positively taken by the market. And then in terms of Colo 2 DR or Colo 2 secondary solution, that is just our DR solution that is located at Terraco. And it just unlocks sustainability resilience. And it really lowers the all-in cost to access the JSE. So if you got any question along this initiative, please reach out to us. Nash, I don't know, I can't see him here, but he is our expert. So if you've got any question on those 2 initiatives, happy to take question or have follow-up with you and your teams. Moving on to equity derivatives, as I said, our focus is to offer fit-for-purpose products to the market. And we are very excited to have launched a couple of new products, out-of-barrier options, out-of-currency options and single names. And we are still looking at doing IDX options. I have asked the team to make a list of all the products that we're offering, because I know there's been a lot going on and not everybody is totally familiar with it. So we will be circulating a list of all the products that we're offering, especially the new ones, and happy to have one-on-ones to engage in terms of how they work. And there has been a couple of questions in terms of valuation of these products. So we're happy to engage with the teams in terms of that. And then the other thing that was a big ask for from the market was the price bands on roll trades, which will be going live in the next couple of weeks. I was told in the next week or 2. So please watch out for that. I know that was an important one for the derivatives desk at the banks. Moving on to cash equities, I would just like to give a quick update onto our main projects, which was the block liquidity project. So that is obviously providing a solution to the market to have access to the dark pools. And we have been working on it for quite a while, but it's just that we've been looking for providing the market with the best solution that will be cost effective and that would be, with like the latest technology, including the conditional functionality. It's not just going to be like an auction in a dark pool. So it has taken a bit of time, but we really want to deliver the best-in-class solution to our clients. So hopefully we'll be looking at confirming which way we're going to go, which vendor we're going to go in the next couple of weeks, and we'll be communicating that to the market. In terms of currency derivatives, I guess, as I mentioned, the one important thing was just to standardize the reference rate that we use during closeout. And there has been a lot of engagement with the markets, and we have finally settled on one benchmark, which is the BFIX. So now the ball is again up to us now just to get that finalized and be able to use that going forward. But we have engaged with the market, and it has been great to hear all the feedback and all the, all the proposals put forward. And then the other things that's going on there is obviously the RFQ trades, RFQ capacity functionality, whereby we just want to attract some of the OTC volumes that's going through, and we want to bring it on book. So that's one key focus item there, as well as the strategy trades. We understand that when we're trading strategy, is quite painful if we have to book individual legs. So we are working on those two things in that particular asset class. Moving on to commodity, I think Robin has mentioned, we have obviously, we got a long way to go in terms of the migration, but in the interim, we've got these free releases that we have committed to the market just to try and stabilize this asset class or this infrastructure for commodities, which has been delivered. One of them has been delivered, and the rest is going to be delivered in September and November. Moving on to interest rate derivatives, there has been a big, need from the market or demand just to list a Zaronia future. So we are that's one of our key items that we are going to be focusing on now that we've gone live with the repo project. So we'll be engaging with the market in terms of how to spec that one out. And the last thing I want to mention for cash bond, obviously we have gone into, we delivered the phase 1 of the bond repo project in May, and we know that there's a couple of overhangs that we are going to be now speaking out and seeing what's the best way of delivering that to the market, but we still remain very committed to, to that project. And then the last piece that I want to add, which adds to the commodity piece, is just the migration of technology for the bonds market. Just so that it's sustainable and we provide maybe like on-book trading, etc. So we will be going through with our partners in the market just to see what is the strategy for bonds for our market. I will also take a pause here and just see if there's any other question before I hand over to Alicia. If there's no question, Alicia, thank you.
Morning, everybody. Morning. I asked Erica why she doesn't have questions for Robin and Alina, but she's told me she's saving them for me. All the special questions. Morning, everybody. Right. So just quickly to run through, I think that a number of the projects in the post-trade space are of a longer-term nature. So many of these you would have heard of in our earlier last quarter's feedback sessions and before that even. Also, both Elena and Robin have mentioned some of them. So as I go through them, I'll try to give you a slightly different angle from a post-trade point of view. On the equities space, there's a lot of work going on, both on the tech side as well as the business side. Robin's already spoken about BDA modernization. Just to touch on that one, because it is sort of halfway through at the moment, and we're really in the thick of that. To echo Robin's sentiment that we've been really impressed with what we've seen from our tech partners with the modernized code that we've seen, and we're very comfortable that the functionality, we always promised that there would be no change in functionality, and that is exactly what we are seeing, that there's no risk of functionality coming out slightly different from what we are used to today. That's a very critical part of our risk management there. So bond BDA modernization continues until 2027. In parallel to that, we've been working on two things from a business perspective. The one is the BDA fee model, a revision of the BDA fee model. Those of you that are in the equity markets have been involved in a number of conversations with me around our longer term vision for the equity markets. We speak about moving to a non-mandated BDA world where we have CAPAD as a risk management and regulatory mechanism as we do today, but without the need for mandated use of BDA in the way in which you have to do that today. So that is one element that we're looking at. Beyond that, we're looking at things like shortening the settlement cycles in line with international practice these days. and also ultimately moving to a CCP. So there's a long roadmap of transformative work that we're looking at and considering in the equity market. The fee model, coming back to the fee model, addresses what that long-term vision represents for us in terms of charging differently for regulation, charging differently for risk management or CCP, and charging differently for accounting elements that may or may not be used by brokers when we get to a world that's a non-mandated BDA world. So we've done a lot of work on the fee model. I know that it's been a little bit frustrating that it's taken as long as it has, but it is, of course, a very critical and important part of all of our lives, brokers and the JSE, and we need to make sure that we get it right and treat all of our brokers equitably. If anybody's done a mathematical swap out of one model to another model, it's always tricky. And really what we've been dealing with there is really just to try to find the sweet spot in the model that addresses our long-term objectives for what the equity market operating model will look like and will be reflective of that going forward, but also that doesn't create unintended negative impacts to any of our market participants in the short term. So I'm hopeful that we are able to communicate you where we've landed with that before the end of this month. We have had a few consultation sessions. Thank you to everybody for your feedback on that. There are a few internal governance elements I need to wrap up now, but I'm hoping to get to you with the finalization of our position on that before the end of July. Right, then on equity market transformation, we have been doing a lot of internal work of the operating model that supports CAPAD, non-mandated BDA, okay? I know many brokers have been asking for that because for many of you, your preference would be to use your own accounting systems and to not use BDA for the accounting elements or in a mandated way, and particularly for the accounting elements. Of course, I think everybody understands that there are still JSE systems that have to be used as for any other exchange in the context of executing trading and doing market regulation and so on. But we are looking to alter that slightly so that you don't have to use it for all of the elements that you use it today. So that work is actually progressing pretty well. We have spent an enormous amount of time internally designing and brainstorming what an operating model could look like. That basically boils down to an operating model in which brokers calculate CAPAD yourselves outside of the BDA system and provide information to us. The implications, of course, of changing that means that we still need to worry about how we do regulation, how we do supervision, how we do risk management, how we do margining, how we do settlement. All of these things hinge off the data and the capability that we have in BDA today. So if we take a piece of it out, how do we deal with the other, with the elements that have to remain as part of our fabric? So we hope to, we're currently documenting our thoughts, and we hope to come to probably not the entire market community, but one or two players who just start testing our ideas again within the next 4 to 6 weeks. We are also considering, and I say this at risk of being minuted and held to account on this, we are also considering whether we are able to come up with an operating model that has a hard dependency on completion of BDA modernization, i.e. can only be implemented after we've completed BDA modernization, or whether we can find an operating model that we could implement before the completion of BDA modernization, which of course I think would be very well received by the market. So I can't promise that, but we are trying to find an operating model that would allow us to do some of that. Okay, let me move on to packaging of post-trade data. We are doing some work, I think, for many of you that we have been discussing in the BDA fee model. We've been showing you some different slices of information and data that we have at hand for the equity market, particularly from the post-trade perspective, settlement statistics, post-trade effective rates, etc. We are looking to package that data differently and be able to make it available to the market for consumption on an ongoing basis. And then lastly, there's a lot of technical things happening, ZOS upgrades, KICS upgrades, mainframe migration, I think that many of those are sort of standard initiatives that we run on a regular basis. They all relate to operational resilience, making sure that our BDA system keeps running until such time that we've modernized it and have a completely different technical operating model supporting it. But I think all of those upgrades we have communicated to you about before, and they are underway and they're going pretty well. I think from the market's perspective, we will just ask you to keep an eye out for various communications around a little bit of testing, a little bit of regression testing that obviously our team will take the bulk of, but we will ask some of you to do some of your own independent testing on these as well. Right, on the SARS monthly reporting issue, we have on a number of occasions gone back to SARS to clarify certain elements of that. We have not heard anything back from them at all. So from our perspective, we have actually taken that off our roadmap for the remainder of the year while we await their feedback, which is really relating to clarity around the business requirements. Okay, let me move on to bonds. Yeah, bonds CCP is currently one of our larger transformative projects in the post-trade environment. This is all about replacing bilateral risk management in the ETP market with CCP or central clearing type risk management. It will be mandated. All ETP trades will have to go through the central clearing or the CCP mechanism mandated by the National Treasury in an effort to grow the bond ETP market. CCP works really well because it helps you to manage risk when you have an anonymous counterparty on the other side. When you don't have sight of the party on the other side, it becomes very tricky to enter into trading if you don't know whether you're dealing with an A-rated bank or whether you're dealing with a retail client, whatever the case might be. So having the CCP there takes away this problem with anonymity because all your trades get novated and the CCP itself becomes your counterparty. And it's on that basis then that Treasury is looking to introduce that and thereby enable broader participation beyond just the 10 PDs in the bond ETP market. So that project's going really well. We've done a lot, if not all, of the business-related elements of it. There are a large number of risk models, risk policies, default fund considerations, and so on that have been completed and signed off by the risk committees and the clearing banks. We've rewritten new rules for JSE Clear as they relate to cash instruments because we don't have cash instruments today. And we have submitted our application to the regulator for their approval. So while the regulators, and there are 3 or 4 regulatory bodies that will have to give their approval on that license application, while they are opining on that, we will now start the technical build. And the technical build is work that the JSE and the JSE Clear has to do, as well as our clearing member banks. So it now becomes a little bit tricky because we have to coordinate that tech development effort across a large number of players external to the JSE as well. All right, but otherwise at this moment, we don't have any material risks to raise in that particular project. On derivatives side, we obviously are delighted to hear that South Africa is doing so well with the FATF, because that does play directly into that first point around the Bank of England recognition of JSE Clear. I'm also pleased to say that even though we've had this risk hanging over our necks for some time, we haven't seen a material reduction in international investment in the derivatives market and therefore in JSE Clear as a result of this risk. So hopefully we can avoid it entirely by getting off that grey list and getting back into the Bank of England's good books without sort of having a lull in our recognition. But we are required to resubmit an application to the Bank of England, which we are going to be submitting before the end of this month. We are working on margin methodologies. Many of you will be aware that we have spent the last 18 months reviewing all of our margin methodologies in JSE Clear. As a result of that work, we have been able to reduce the margin that we ask of you, particularly in the equity and currency derivatives markets. We now have turned our attention to commodities, which is the last material market that we'd be looking at, and you'll see some changes coming through in the second half of this year, probably during Q3, I think. Again, looking at data to see if there's any JSE Clear type post-trade data that we can make available to the market. And then, of course, a lot of upgrade, operational resilience work, a lot of upgrades of the STT environment, which is our standard practice. We've had 2 successful upgrades to date, and I think there's 1 more planned for the rest of the year. Again, for clearing banks, a little bit of regression testing involved with that, but no functionality changes, just a few sort of niggles and bug fixes required there. Across all of our markets, of course, every time Elena comes to market with a new product that she wants to list, that means that we will have to do work in the post-trade space as well. I haven't listed them specifically, but just to be aware that as we bring new products and instruments to market, we do have to do the work commensurate with that in the risk management and margining space. So that will also be on our radar, although I haven't explicitly listed it here. And then finally, digital assets. We are still looking at how we get involved with digital asset markets. Helena mentioned before that there is work in progress, hopefully to go live in 2026, around the listing of crypto-based ETFs and ETNs on our traditional platforms, as you see in other exchanges globally. That work has, we've defined an operating model, a regulatory oversight model, and we're busy discussing that with the FISCA and the PA now. Once we get the approval, we would be able to list those types of products on our existing markets under our existing license and using our existing tech. What we're talking about here is something a little bit different. This is the implementation of blockchain, fintech type environments to actually launch tokenized instruments, full digital instruments, spot cryptos, all of those things that we all hear about, and sometimes they sound a little bit strange. That is what this project is about. It would be under a different license, would be under different technology, and will enable different types of instruments, tokens, or pure digital instruments of any nature to run. So there are a number of options that we have available to ourselves in that space. We have been speaking to the market around, the needs in the retail space versus the needs in the institutional space to have access to these types of instruments. And that really is guiding us in terms of what we would develop and build there, both from a business perspective as well as from an IT tech perspective. All right, so I think that was all I had to present. Somebody give Erica a microphone, please. Any questions while we get this? Any questions online?
Yeah. Hi, Alicia. We have 2 questions online. One is for you and the other is for Helena. But the question for you is how far you would reducing the settlement period from the current 3 days?
Yes, that is, sorry, I neglected to mention that. It is my intention to, over the course of the next 6 months, get a white paper going, which we will write with the broking community and investors to just really get our heads around what we think is the right settlement model for us in the context of the shortening settlement cycles globally, as well as the implications of moving to a T2 or a T1. So we'll have that white paper going. I think technically what will be difficult for us to think about is where we fit this in to our larger agenda as we have it for equity market transformation. So there are a lot of things happening in the equity market, BDA modernization, which is obviously, the engine on which future projects would need to be run. If we can't do settlement cycle reduction while we're fiddling with the car's engine at the same time. When we look at non-mandated BDA CAPAD, that needs to be considered in the context of, do you do that first? Do you do it in parallel with the settlement cycle shortening, etc.? So the one element is which is the right settlement model for us. That we'll start talking about in the next 6 months. And then once we've decided that, where do we slot it into our roadmap? So I think people should just be a little bit patient with us. It's not something that at this moment we are able to drop what we're doing and focus exclusively on that. We need to sequence everything quite carefully. If I can just appeal to all the trading members out there to give this some thought. obviously for us to consider the value proposition to South African markets, to move the to a shortened settlement cycle. I mean, we're all chasing liquidity. We all want to stay internationally relevant. But is it required for us to go all the way to a T1? Would a T2 be good enough? Bearing in mind that technically this is going to be a project that's onerous not only on the JSE, but also on all trading members who will be required to change their systems as well as CSDPs. So give some thought around the value proposition of a T2 versus a T1. I'm very interested to hear your views on that. What's your second question?
The second one is for Helena. Yeah.
Oh, she's got a mic. You can ask
Oh,
her.
you got it. Okay, yeah. So Helena, the question for you from Sam is, are you considering listing CFDs?
Okay, sure. Hello. Hi, Sam. Are you online?
Yes, he is.
Okay, online. So we do have a product actually that's listed currently. That's called an ECFD, but it's quite inflexible. I don't think, and that's what I was talking about when we talk about fit for purpose. We are busy reviewing that particular product, just to make it, more flexible. We should be able to list it, with any expiry, for example, and using different benchmarks. With Zeronia going live, so that's going to be key. So yes, we are looking at revisiting that existing futures that we have, called an ECFD, to make it more flexible, make it more fit for purpose, and give market participant option to be able to list it with an any day expiry. So being able to choose an expiry that that suits their books. Thanks.
Thanks, Helena.
Thank you.
Any further questions?
Nothing online.
Oh, no, yeah, Erica, just pass the mic across. Thank you.
So Alicia, I think you missed a trick there to tell everybody, and congratulations on your clearinghouse nomination, or
Oh yes, I forgot about that actually. Yeah, so I think not everybody might have seen that we've just had a review of our JSE Clear operating model against the international IOSCO best practices, the PFMIs, IOSCO PFMIs, and we got a clean sheet. We achieved fully observed across all the not all the principles are relevant to us. Most of them are, and across all of them we achieved the highest rating that we could, which is an improvement from where we were the last time around. And that's really important because I think particularly for our international counterparties who are held by their regulators for certain regulatory capital holdings against who they have exposure to, as well as their own mandate, is very important for us to maintain international standards at all times. Otherwise, it can be prohibitive for those internationals to operate or to trade in our markets. So thank you for reminding me, Erica.
well done. So my next statements or questions are really around the interconnectivity of cap-add model, as you've mentioned, margining, CCP, and settlement cycle. So if we're looking at them in isolation, it might not be the most operable. So should we not be looking at it as a project holistically, instead of saying that, yes, we are busy with BDA modernization and where do we fit it in? Actually, they're just so interconnected that if we do it alone, we could potentially lose out on one or the other, because the one might become more important than the other. And if we aren't looking at them collectively, we've got a problem.
I would completely agree with that, Erica. And I've been thinking that if I could wave a wand and have my wishes come true, that one would get to a non-mandated BDA cap-add model, as well as a shortened settlement cycle, for example, at the same time. The question would be, how big is that piece of work? Are you biting off more than you can chew in one piece? But I agree. I mean, to look at how we can consolidate in terms of effort, as well as think through all the implications of all of these changes up front, rather than only realizing some of the implications later down the line. Very important point.
And then the last thing, it's on your cap-add and margining. It's just what happens to the guarantee fund and the guarantee pool and things like that. Would that come up in that discussion?
Correct.
And not to forget
Yes.
about those.
Yes. Yeah. So the guarantee pool and the guarantee fund and the way in which we settle has all got to do with the way in which we risk manage the market. And for us to ensure that the risk management element isn't deteriorated to a point that we no longer feel comfortable to guarantee, Or in fact, in a space that you move to T1, you do expect a lot of fails. You see this in international markets. How does that actually change our risk appetite? So we will definitely be looking at that. I mean, we have no intention to remove our role in that sense. I think it adds a lot of value to the market, but it will have to be tweaked and changed in some way as the risk of settlement failures increases as you reduce settlement cycles, but also as you take on new risk where you don't have the amount of data available at your fingertips that we have today to manage settlement risk.
And then lastly, I'm sure you know, is ensuring that the community is brought along from the beginning
Yes.
and not at the end of the discussion.
Yes. Great. Thanks, Erica. Great. I think I can now hand over to Barbara. I think, Barbara, you're up next. Thanks, guys. Oh, sorry. One more question. You just need to speak in the mic, please, so the guys online can hear you.
Okay.
There we go.
I just want to have a quick reflection quickly. Maybe you can help us. With the last time we reduced the settlement cycle from T5 to T3, top of mind, what are some of those lessons that we need to be cognizant of moving into the new reduction cycle?
Thanks for the question. Yes, I think it was 2016 or 17, we moved from T5 to T3. It was a pretty big technical project. I mean, quite a material reduction in the settlement cycle. Today we are at T3 and we're looking at, do we move to T1 or do we move to T2? I mean, those are the options that are available to us. To be honest with you, moving from T3 to T2 will be less onerous technically than moving to T1. As things stand today, we already have settlement commitments largely completed by the end of day T2. There are always a few, maybe 10 or less than 10 trades that are not yet committed to on the morning of T3, but they're quite few compared to the bulk that are committed to by the end of day T2, which means that our systems can actually handle with commitments by the end of day T2. The issue would be that processes would have to change. You can no longer only be ready for settlement at 4 o'clock on T2. That would have to move forward to earlier in the day, maybe 12 o'clock. I'm just making up time frames here, but much earlier in the day, maybe noon, which means that you've lost 4 or 5 hours during the day as trading members to get your stock in play. You know, when you talk about short arrangements, those have to be brought in a bit earlier. I think some trading members may have to do a little bit more pre-funding or the cost of having that stock on balance sheets quite a few hours earlier. I think that's where the difficulty is going to be for a T2 settlement approach. I think technically it's probably not too bad, but that will be the most difficult part. Certainly we will see more failed trades, we will see more rolled trades, even on a T2 basis, because I can tell you, even though we have a pretty good position at the end of day T2, by noon of T2, it's still a bit, you know, open. Moving to T1 would require all of us to make systems changes. There's no shadow of a doubt on that. So BDA, ECS, straight systems, all of the CSDP systems, all of the broker systems would have to be changed for a much shorter processing time into T1. And again, the problems that we have around process, around having stock available, around failed trades and so on, they'd be the same problems. They would be more elevated in a T1 space. So T2 is undoubtedly much simpler for us to do. I don't think it's of the same order of magnitude of work that was required going from T5 to T3, but work nonetheless. And as I said, a change, I think, in some of the principles in our market in terms of settlement success on a daily basis. We still have a market that has basically 0 failed trades. From a rolling of settlement perspective, we roll very seldom. In fact, we rolled today. I think it was the first time in a year or 2 years that we've rolled, if my memory serves me correctly, but that would be a daily occurrence. And so changing processes as to how we deal with these things, what the implications are on the brokers or the investors on the other side, those are the kinds of principles that we'd have to look at. no matter which one we move to. Okay, Barbara, let me hand over to you. Thanks, everybody.
Good morning, everybody. I'm going to talk to you about the information subscriber impacts for the next part of this year. So the first one is harmonization, and we've been speaking to the market for a while about this. In fact, since 2019, and that was through the natural harmonization that was happening with the SWIX and the core series. So the first thing we did is in March 2024, we harmonized those two data sets. So they were one and the same, applying the SWIX methodology to the core indices. And the next date to be aware of is December 31, where we will decommission the SWIX data series. So if you are still using that series, I'd urge you to please reach out to your market data account manager and chat about that. Number two is our property index. We put out a consultation paper on the property index in November 24. That was as a result of some of our index clients coming to us to say, could we possibly include fledgling companies into the ORP? The result, though, as we put out the consultation paper, there were other market participants who would have challenges if we did that. So we are still in a consulting phase. If you would like to give input, please do so to the indices group. It's indices@jse.co.za. Issue evaluated instruments, and some of these are long running. This one has been quite a long running one where we've wanted to include the unwind prices on CLNs and structured products from the issuers. We are in a POC phase and working with some participant banks, and hopefully in Q3, we'll put out some mark-to-market prices on that in the mark-to-market. On the liquid government bonds, this is also a 2025 project. We're looking at the methodology that we're using for the pricing of those bonds. Current methodology is we use MTN, which is our ETP platform, MTS, sorry, ETP platform, and we take the pricing from there. And the market feedback was that perhaps that's not the best methodology, and we should be looking at the contributor bank and IDB pages to get those prices. So that is currently in a POC phase. Once we've finished that phase, we'll put out a methodology paper to the market for comment. The standardization of index treatment across indices and our single stock derivatives is another long running one. I think many of you have probably heard of that one before. We've made some significant progress. So whilst we have done some work on the withholding tax treatment of cash dividends for your Swiss capital reductions and some of your recurring special dividends, we have aligned those methodologies. We've closed most of the gaps, and what we're planning to do now is look at our internal process around how do we communicate to the market about these complex corporate actions, giving the market enough time to do what they need to do on their end. SENS replacements, my colleagues touched on this one. SENS replacement, that project is starting now in 2025. The impact will be experienced by the issuers and the sponsors in 2026. So the project will look at the front end, the capture screens for the sponsors and the issuers. There will be no change to the information subscriber products. However, we will ask you to engage with us and help us in regression testing, just in case we introduce anything into your environment that we don't intend to. So that's for 26, not for 25. The next one, Zeronia linked FRNs and ISINs. So my colleagues have explained or talked about what we've already done there. What we're busy with now is the Zeronia swap curve. So we have created a Zeronia swap curve, and we will be issuing that out. It's going to be quite soon that we're going to start issuing that out. and then we'll take feedback and we'll then turn that from a beta into a fully fledged product once we've made sure that everybody's happy with that. And we are going to continue with the JIBAR swap curve for as long as JIBAR is around. Steffi, on the Steffi. So we believe that Steffi is still an important domestic benchmark, and we, the JSE, will continue to be the benchmark administrator of the Steffi. However, we're sure that some clients will look for a Zoronia benchmark. We've taken feedback that there are clients that would like the Steffi to continue. We're not quite sure on the methodology. We are engaging with some ASISA members to see what we do there and how we incorporate Zoronia into the Steffi. Okay, that is that screen. This one, okay, this is more the interesting new things that we've been up to. The first one, Market Data Connect, and there is some client impact here for you in 2025. So Market Data Connect has been around for about 2 years. About 2 years ago, we put out our Market Data Connect platform for clients to give us their reporting numbers on any reportable products. You're already using this platform. Then last year, what we did is we added the indices agreement, the IDA agreement, to this platform so that you could then sign with us digitally if you took an index product. Now, in 2025, we are busy with the workflows to digitize our JDA, our data agreements. And that is what we will do is we'll notify you, we'll give you ample time to review your digitized JDA on the portal. You will either elect to re-sign or deem it, you'll fall within the deemed period to have agreed to it. So we've made no changes to the data agreement. What we've done is we've simplified it. We've moved all the base plate terms to a base plate and put specific product terms onto the schedules. So we're hoping that we've made your life easier, not harder, and you look out for that notification coming in 2025 still. The marketplace, that is our new data shop. So please go take a look, marketdataconnect.jse.co.za. And there you will find the products that we have already put onto the marketplace. The first phase of that project took us a while, because what we had to do is we had to move all our data to our data lake before we could start generating new product. And now we're well into the product engine, if you like. So on that shop, you'll find some end-of-day equity products, some streaming equity products. We've done some sense products. We've done company financial products, and we're continually iterating. So please do go have a look, subscribe, send us some questions, and we're happy to help you out there. Third-party data. So that we've been wanting to add data sets for our clients that make sense with your financial data requirements. So the first one has been Trade Explorer. That was initially a broker driven outreach where we looked at the trade execution analytics and some market penetration stats, etc. So now what we're doing is a public launch. So next week, please watch out for the public launch of Trade Explorer. It's aimed at a new market, and we're quite encouraged by some early interest from the asset management community. So look out for that one. Other than that, there are some ESG tools. I'm not going to go into detail. The one will help you with your sustainability submissions. If you're a corporate doing a sustainability submission, it's got a easy walkthrough workflow that enables you to do that. Has also got GRI and other international frameworks. Also in the ESG space, if you're interested there, we have some ratings information available. We'll continue to look for third-party data that makes sense for our clients and continue to add. Policy changes. So nothing really, well, one policy change happening in 2025. Nothing's happened up until now. The one thing we're doing, which hopefully will make your life easier, is a simplified policy document so that you don't have to go read all those pages of policy. We've simplified it, and that will be going out in the next couple of months. And then the only other policy that you should look out for in 2025, which we are changing, is the non-display policy. We added some elements to non-display last year in the form of trading platforms, and we're busy with the research to see what elements we need to tweak and change in 2025 for that. And that is a wrap. I hope I stayed within my 10 minutes. If there's any questions.
Hi, sorry, just a question on the public launch of the data.
Yes.
Data that's going to be on that supposed portal or website,
Mm.
I'm presuming is more aggregated data. than
Anonymized,
anonymized,
aggregated.
from just a popular perspective and
Yes, absolutely. So it's all anonymized, aggregated, no private data. You know, we've been very careful about that.
thank you.
Good. Thank you. And I'll be handing over to Seppo. Thank you.
Good morning, everyone. I'm actually not sure if it's an advantage speaking at the end, or I'm going to feel a bit rushed, but I'll take it from the top. I won't necessarily try to stick to the script. Internationally, or in some jurisdictions, okay, where's the clicker? Sorry. Internationally, from a standard setting angle and from a jurisdiction angle, there are certain key themes in terms of what's in spotlight. Alicia's talking about tokenization, and Barbara's talking about touched on third-party data. So the key themes from, for instance, the Financial Stability Board is third-party risk management, wherein they provided guidance and a toolkit. We're also seeing tokenization as well, them touching on tokenization. On the sustainability side, there is IFRIs, wherein jurisdictions like Europe and the UK are really trying to implement the sustainability standards within their context. Now, coming home, legislation takes time, regulation takes time, and I suppose it is for a reason, because we have a consultative process wherein documents have to be out for public comment, and then the legislative process continues. I will touch on, so some of the updates may be common because they have been continuously on the map over time. Currently speaking to coffee, the coffee bill, it's currently before the state law advisor for certification before it can be tabled in Parliament. Moving on to the Financial Markets Act, it is expected that moving back to 2020, remember there was a policy document regarding the review of the FMA, amongst others, to permit certain types of trading venues like multilateral trading facilities. So in that process, currently the FMA is under review, but we understand that whatever changes or whatever amendments will be incorporated into an omnibus bill running parallel with the coffee bill. Now, moving forward to culture and governance, speaking of technology, the current draft standard, or there's an understanding that the FSCA might include certain high-level principles into the culture and governance standard to really take care of the use of AI and machine learning by financial institutions. So we are looking towards the publication of the draft standard sometime in Q3 2025, as well as there's also work in progress to conduct a study by the FSCA to really assess how AI impacts the consumers, as well as influence the market and financial stability issues as well. On sustainable finance, as I've said, sustainable finance. On sustainable finance, as I've said, that there's talks within FISCA to introduce climate-related disclosures for large and listed entities in order to incorporate or align with other jurisdictions. Currently, they have undertaken to assess how sustainability requirements will probably be faced in terms of other categories of entities other than the listed ones. On third-party outsourcing, we are expecting a draft conduct standard on outsourcing sometime later in 2025 or 2026. We had anticipated that it would have been issued sometime earlier this quarter, in the previous quarter. On recovery and resolution plans, we expected a revised standard within this quarter, but there hasn't been any for second consultation. We'll probably be seeing it within 2025, before the end of 2025. That's all. That's a wrap from my side. I'm not sure if there are any questions right on time. Thank you.
Any other questions for any of us? No? So guys, we will commit to having one more session, probably Q4, November-ish. We'll finalize a date with updates, obviously how we landed 2025 and what we're setting up for 2026. But a lot of this will still hold other than a little bit more refinement. And look forward to engaging with those in the room outside now for further chats and conversations. But thank you all very much.